What's going on, guys? This is Brad. Welcome to the Mortgage Mechanics channel. Today we're going to be going over how a monthly payment is calculated. You may have heard the term PITI before, and that's kind of what we're going to be going over right after this. All right, so what is PITI? PITI stands for Principal, Interest, Taxes, and Insurance. And those are going to be the four parts that make up your mortgage payment. Now, there are some other things that could come into play, like private mortgage insurance, PMI, but we'll talk about that on a different video. But for now, so we're going to go over these four parts. First one being principal. So we'll say that you get a house that's worth $200,000. You put 20% down, so you're putting down $40,000, and you're financing $160,000. So your principal is going to be that $160,000 that you're borrowing from the bank. And if you get a 30-year fixed rate, you're going to be basically paying back that $160,000 over the course of 30 years, and that's going to be the principal. Now, going hand in hand with principal, the next leg on the PITI is going to be interest. Now, interest, this is how the lenders make money. This is how the lenders do business, right? This is, as much as they like you, they still have to do this. They still have to charge you interest. And that's going to be a percentage that they take for lending you that money. So in certain scenarios, you can have a changing or a ranging interest rate, and it's best to get a 30-year fixed rate or a fixed rate mortgage. And that means that what you're going to do is you're going to lock in that rate, and that's going to be the rate for the entire length of the loan. There are adjustable rate mortgages where they can fluctuate, and 1 month you might be paying a higher interest than the next. Now we're going on to the next one on our PITI, and that's going to be taxes. So in each monthly mortgage payment, there's going to be a payment that goes into an escrow account, and that's for your taxes. So local governments where you collect taxes to support firefighters, police officers, schools, that type of stuff for your community, and that's why they're going to collect those property taxes from you. Now, you're gonna have an escrow account. Your lender's gonna take money each month for those taxes and put it into an escrow account. So when your local government looks for those property taxes at the end of the year, that money has already been collected. It's sitting in an escrow account. Your lender will send it to them, and it's kind of out of sight, out of mind. And the next one, the last one, is going to be insurance, and it's kind of the same thing as taxes. It's going to be collected by your lender, and it is going to be put into an escrow account, and that's going to be your insurance for your house. Some insurance might be a little bit more, some insurance might be a little bit less, but all in all, they're going to take that money, they're going to put it into an escrow account, and when the insurance is looking for that payment, it's going to be right there. Lender can send it to them. That money's already there, and out of sight, out of mind. Anyways, guys, that's going to be how our monthly mortgage payment is going to be calculated, and I'll see you